All right. Today is Wednesday, July 28th. This is a recap for the stock market activities today. But we start with the crime of the century by the Federal Reserve and central banks around the world, creating hyperinflation, creating the biggest wealth inequality gap in history, and destroying the prospects for any prosperity for future generations and poorer countries. And that leads us to In Focus tonight. What else? The FOMC meeting and the press conference by Fed Chairman Jerome Powell. We start by the first question by Steve Leisman of CNBC, who is also known as a bootlicker for the Federal Reserve because he aspires to be a Fed member or a Fed president someday. And of course, Leisman, every time they get the news and he reads the news on CNBC that the Fed is not tightening and it's going to continue its so-called accommodative policy, which also means propping up the stocks and real estate markets, aka the assets of the wealthy. And Steve has this look on his face. Yes, they're not tightening. The only tightening is happening in my pants. But to my surprise, Mr. Leisman did challenge the Federal Reserve and Jerome Powell by asking a real question. Wow, what a surprise.
Thank you very much. Mr. Chairman, I wonder if you might be able to put some, numbers or maybe more detail around this concept of substantial further progress. What counts as the progress numerically, if you will, or citing data, if you could, that you cited in the statement today? And if you could be more specific about what substantial further progress would look like, and if that would then lead you to an announcement of an actual reduction in the purchases of your assets. Thank you.
Great, thank you. So, more detail on substantial further progress. So, let's talk about the maximum employment part of that. As you know, with maximum employment, unlike with price stability, where we can target a number 2% on average, with maximum employment, there isn't a single number that we can target. We monitor a broad range of data about different aspects of the labor market. There's unemployment among different age groups and such. There's participation, there's wages, there's all kinds of flow data, and we look at all of it to try to arrive at a picture of what is maximum employment. So I can't give you a set of numbers, for example, a numerical threshold like we used for a time back in 2012, I guess it was. We didn't do that here. What we said was substantial further progress toward our goals, and what we said was we would keep, effectively, we would give advance warning as and more and more clarity as we move forward. And that's what we're going to try to do. So what would substantial further progress be? I'd say we have some ground to cover on the labor market side. I think we're some way away from having had substantial further progress with toward the maximum employment goal. I would want to see some strong job numbers, and that's kind of the idea.
And look at Jerome's face. He's like, motherfucker. Why is he asking a real question? Doesn't this guy want a job at the Fed?
If I could follow up, you talked about one side of the equation. Does it mean you feel like you've reached your goal when it comes to the inflation side? Thank you.
So inflation is running well above our 2% objective and has been for a few months, and is expected to run up certainly above our objective for a few months before we believe it'll move back down toward our objective. The question whether we've met that objective formally is really one for the committee to make. I can't do that by myself, but it's clear that at this time inflation is actually running above 2%, and again has been and will be, at least we expect it will in coming months before returning down toward our target.
And this is all a bunch of crap. He dodged the question. He danced around the corners of the question. He never gave an answer. He keeps saying, oh, this is for the committee to determine. Well, you're the chairman of the committee, you moron. And of course, the question was extremely clear. What do you mean by Further substantial progress. What does progress mean, Mr. Powell? Because we have no guideline at all. You continue to say we're waiting for further substantial progress. What does that mean? We know that you're watching inflation and unemployment. These are your so-called mandates, dual mandates. But we all know that the real mandate of the Federal Reserve is to prop up, protect, and inflate the assets of the wealthy, stocks and real estate. And Leisman is asking a clear question. What is progress, Mr. Powell? Because inflation is already exceeding your so-called goal of 2%. So what is progress here? Employment is getting a little better. We have over 9 million jobs openings. So what are you waiting for, Mr. Powell, before you start tapering? What is progress? He danced around the question and he never answered it. So let's hear attempt number 2.
In March and April, you noted that a transitory rise in inflation above 2% this year would not meet the threshold of moderately exceeding 2% for some time. And I noticed you didn't repeat that qualification last month or today. And so in your view, has the rise in inflation this year met the threshold of moderately exceeding 2% for some time?
That would again be a question for the committee, but I would really say...
Here he is once again. This is a question for the committee. You're the chairman of the committee. You f***. How about we ask the homeless guy down the street what he thinks about this? If the chairman of the committee is not giving a straight answer, then who will?
Now can't you give me a straight answer anymore?
The guidance that you're talking about is really the guidance to do with liftoff, right? That's what the guidance is for liftoff. We had to have labor market conditions consistent with full employment, inflation at 2% and on track to run moderately above 2% for some time. It really isn't relevant now, because we're looking at tapering asset purchases. We're clearly a ways away from considering raising interest rates. It's not something that is on our radar screen right now. So when we get to that question, when we start to get to the question of liftoff, which we are not at all at now or near now, that's when we'll ask that question. That is when that will become a real question for us.
And again, this is garbage. He's talking about interest rates. Nobody's talking about interest rates right now, Mr. Powell. We know you're not going to raise interest rates right now because with all the zombie companies and zombie economies, including ours, by the way, the United States of America is a zombified economy. Raising interest rates will nuke the entire planet. We're not talking about interest rates here. It's a simple, easy question. What do you mean by further substantial progress? We have the hottest inflation numbers in decades, and we have the highest number of jobs openings in many years, perhaps the highest ever, and these jobs are not being filled. So what are you waiting for, Mr. Powell, before you start tapering? What do you mean by our goals? Let's hear attempt number 3.
Hi, Mr. Chairman. So bond market pricing seems to suggest that investors think the Fed might eventually over-tighten. So my question is, do you think that markets have bought into the central bank's new framework, and how do you balance that with managing inflation concerns?
Well, so in terms of what's been happening in bond markets, I don't think there's a real consensus on what explains the moves between the last meeting and this meeting. We've seen the long-term yields go down significantly. Some of it is a fall in real yields, which may have been connected to, some speculate, connected to sentiment around the spread of the Delta variant and concern about growth. There was also some decline in inflation and compensation, which is significantly reversed. And there are also so-called technical factors, which is where you put things that you can't quite explain. So,
and of course, he's talking about the technicals, and he says nobody knows how the technicals work. We know how the technicals work. We talk about them every single night in this show. And of course, he is referring to the bond market mystery. If inflation is rising higher, if we have hyperinflation in this country, and perhaps in the entire globe right now, why aren't interest rates rising higher? The 10-year yields are actually dropping down, and therefore the bond market mystery. We have explored many reasons, including Delta, including stagflation, but perhaps another explanation will be the manipulation from your side, Jerome Powell, the Federal Reserve, printing and buying $120 billion worth of bonds or mortgage-backed securities every single month. At a minimum, perhaps that is distorting where interest rates are and the readings on the 10-year yield. Perhaps the market is seeing, the bond market that is, seeing the future of this disastrous monetary policy, which will lead to hyperinflation, which will lead to the bubble popping, causing destruction all over the economy. The greatest crash since the Great Depression. And we will be left with stagflation. Perhaps the bond market is seeing the future, a future with no growth in the economy, except growth in prices, starvation, and global destabilization.
I don't see in any of that there is really anything that challenges the credibility of our framework, if that's really your question. We are committed to achieving 2% average inflation over time. What we said was that, in particular, when we see a very strong labor market, high levels of employment, low levels of unemployment, that won't be enough for us to raise interest rates until we see some inflation. Of course, what we have today is kind of the opposite. We've got, 7 or 8 million people, fewer people at work than were at work before the pandemic. So we're a ways away from full maximum employment, but we have high inflation. So it's kind of the opposite case, and we have to deal with that. Any central bank has to deal with that by looking at the inflation and asking whether it is broad-based and likely to be persistent, and whether inflation expectations are implicated in a way that could cause them to rise. So we're monitoring that very carefully, and we're prepared to use our tools as appropriate. But again, I think our framework is pretty well understood, and I think the real test of it will be down the road when it's time to think about raising interest rates and how we assess that set of issues.
And here he is, dazed and confused that his policy is not working as he's expected, and the man is extremely delusional at this point. He continues to refer to the Phillips curve, which was proven to be absolute bullshit and garbage over 50 years ago. The Phillips curve has been proven to be garbage. But Jerome says, well, I was expecting by increasing the cocaine operation, by buying billions and billions of dollars every month worth of bonds and mortgage-backed securities to prop up the stock market and benefit Wall Street. My expectations were, from doing that, is that employment will go higher, the unemployment rate will collapse, and then inflation will rise higher, and then we can wrap up the party and reduce quantitative easing, and everybody lives happily ever after. Well, it's not working this way, because the Phillips curve is garbage. And what he has achieved is higher inflation to the point of hyperinflation right now in this economy. Hyperinflation. Yet the unemployment rate remains extremely high from a historical perspective in this country, even though we have over 9 million jobs openings. So perhaps, Mr. Powell, there is no correlation whatsoever between the cocaine operation by the Federal Reserve of buying bonds and mortgage-backed securities to the tune of $120 billion every month. Perhaps there is no correlation between that and jobs creation. And I challenge you and challenge everybody listening to this program tonight to provide any evidence that buying $120 billion worth of bonds and mortgage-backed securities every month has any correlation with jobs creation. I challenge you to provide any evidence, because there is none. Zero. The jobs that we have recovered so far in this economy happened due to the reopening of the economy after shutting it down due to the virus. There is no correlation, once again, there is no correlation between the Fed's cocaine operation and jobs creation. None at all. The only thing they will succeed in achieving is hyperinflation. And this policy will only benefit the rich, the owner class in this country, the 1%, who happen to own stocks and real estate. Meanwhile, for the average American, housing prices are getting out of whack, pricing the majority of Americans out of reach of the simple request of the American dream, owning a home. And here it is, the question about mortgage-backed securities assets purchasing.
Sure.
Hi, Chairman Powell. Brian Chung, Yahoo Finance. Just wondering if you could provide a little bit more color in terms of how you're thinking about mortgage-backed securities purchases as you inch towards taper. Within the context of home prices continuing to rise, we've heard a lot of people talk about the idea that maybe they'd like to cool off on specifically the MBS purchases. Is that more because of the optics, or is it because there's an observed relationship from the committee's view between MBS purchases under QE and a hot housing market? Thanks.
So a number of participants raised that questions around MBS and tapering at today's meeting, as a matter of fact, and yesterday's meeting. And I'll just say that, generally speaking, I don't think that I think that Treasury and MBS purchases affect financial conditions in very similar ways. There may be modest differences in terms of contribution to housing prices, but it's not something that's big. It's not. It's so. Where I think we are is there really is little support for the idea of tapering MBS earlier than Treasuries. I think we will taper them at the same time. It seems likely based on where people are now. The idea of reducing MBS purchases at a somewhat faster pace than Treasuries does have some attraction for some people, others not so much. And I think it's something that we'll be continuing to discuss.
Powell says there is no correlation whatsoever between the increase in housing prices, aka the housing bubble, and us buying billions and billions of dollars worth of mortgage-backed securities every month. There is no correlation. We'll tell that to the average American, Mr. Powell, who are working their asses off to attain the American dream of owning a home. And this is becoming unattainable. Housing prices are getting out of whack. The Case-Shiller Index reached the highest reading on record. This is the biggest housing bubble in history. Furthermore, rents are increasing significantly higher to the point where the average American is not going to be able to even afford paying rent on a studio apartment. Wages are lagging. Rents are rising significantly higher. And once the eviction moratorium, which will expire in a few days, by the way, a couple of days, we will see a tsunami of evictions, the biggest homelessness crisis in history. And I know what the geniuses are going to say. Well, that's going to increase inventory in the market and prices are going to go down. Not when the Fed is artificially propping up the market. And what about the millions of Americans who are going to end up in the streets being homeless? How about them, Mr. Powell? And perhaps this is the most important question from the press conference today. The question regarding what transitory actually means. And here it is.
I think of you as somebody who so lucidly explained policies and programs in recent months and made a real concerted effort to explain them to the American public as a whole. I wonder about this term and what you would say to people who don't know it definitionally, don't know what it means, and see prices going up and wonder how long they're going to have to wait. So just some broader definition from you, I'd like to hear just about what it means or how you understand it. And quickly as well, you've talked about vaccines a bit, and your colleague in Minneapolis has placed a mandate on vaccinating employees coming back to that Federal Reserve Bank. And I wonder if that's something that you would like to see or expect to see system-wide going forward.
The concept of transitory is really this.
First of all, when somebody looks up as they try to answer a question, that's a sign that they're lying. They're weaseling their way around the question. This is exactly what Powell is doing right now.
It is that the increases will happen. We're not saying they will reverse. That's not what transitory means. It means that the increases in prices will happen, so there will be inflation, but that the process of inflation will stop, so that there won't be further. When we think of inflation, we really think of inflation going up year upon year upon year upon year. That's inflation. When you have inflation for 12 months or whatever it may be, I'm just taking an example, I'm not making an estimate, then you have a price increase, but you don't have an inflation process. And so part of that just is that if it doesn't affect longer-term inflation expectations, then it's very likely not to affect the process of inflation going forward. So what I mean by transitory is just something that doesn't leave a permanent mark on the inflation process. Again, I don't mean that producers are going to take those price increases back. That's not the idea. It's just that they won't go on indefinitely. So to the extent people are implementing price increases because raw materials are going up or labor costs or something's going up, the question really for inflation really is, does that mean they're going to go up the next year by the same amount? So you're going to be in a process where the inflation process gets going, and that happens because people's expectations about future inflation move up, and we don't think that's happening. There's no evidence that it's happening. All the evidence is that it's not happening. But nonetheless, we have to watch this very carefully because this is, we have two mandates: maximum employment and price stability. Price stability for us means inflation averaging 2% over time, and so we've got to be very careful about that. But I think it's a good point that it's a term. What it really means is temporary. But then you got to understand that it doesn't mean that the increases will be taken back. Some of them will be, but that's not really what it means.
And here it is. Prices will not go down. This is the admission from the Federal Reserve and Chairman Powell. Prices will not go down, average Joe and Jane. The price increases are here to stay. But inflation will be transitory, meaning that next year you're not going to see an increase in prices again. Well, golly gee, this gives us a lot of comfort, doesn't it? Do I trust this garbage when the Fed itself admits that prices are not going to go down, but inflation is going to stop rising next year? What does that even mean? When my landlord increases my rent by 25% this year, when my utilities, gas bills, my grocery store bills go up 10, 15, even 20% this year, I am incurring these costs. I am paying more. And if my wages are not going higher, then this is inflation to me, paying more in rent. The fact that my landlord is not going to increase my rent by another 25% next year doesn't give me any comfort at all that inflation is transitory, because I am incurring the extra cost as we speak right now, Mr. Powell. And this is, of course, leading to the demise of the standard of living in this country. And by the way, even if wages go higher, understand this: for every dollar you and I get in extra wages, our living expenses will go up by $2. For every buck we get, we're going to pay $2. And I don't trust this definition of transitory. This is garbage. I trust when I hear every conference call from the earnings of companies, when CFOs and CEOs talk about the increase of their input costs, shipping costs, raw material costs, and the fact that they're going to pass these extra costs all the way down to us, the end customers. I trust corporate earnings calls when they say we're increasing wages because we have to, and we're going to pass that extra cost all the way down to the end customer. I trust corporate earnings calls when they say we're taking this inflation with the assumption that it is not transitory. That means the price increases will be permanent. And here is from Ken Longon explaining to you the increase of wages, that it's not going to be transitory. Wage increases will be permanent, and they will have ripple effects across the economy. Wages go higher, expenses will go higher, and corporations will pass that extra cost down to us. For every dollar we get, we're going to pay $2 in extra living expenses.
How much of that is transitory? Like come the fall, when some of these
we're not going to cut
unemployment
somebody's
benefits roll off, how many more people come back to the labor market versus structural declines?
No, what I'm saying is not transitory. When you give somebody a raise, commodity prices go up and down. The price of milk, raw milk, goes up and down. But when you pay a truck driver a raise, you don't go back to him and say, oh, by the way, we gave you $17 or $22 an hour. We're going back now to the old rate. We don't do that. And a round number, about 65% of all corporate cost is labor. So when you're paying, you're not going to take that money back. The tragedy is the people you're trying to help are the ones who will get hurt the most with hyperinflation. All these things that are going on, one of the reasons, Joe, I agreed to come this morning was I am terribly concerned about triggering off a period of inflation like the late 70s. Who gets hit? The little guy. The guy who's buying milk for 4 kids. The guy who eggs and butter and cheese and all these things. They go up in price, they don't come down. And who gets it? Doesn't hurt me one bit. So we spend a little bit more money for milk and we spend a little bit more money for meat. It doesn't impact me. I'm worried about the little guy right now. The little guy is the guy who's going to get it in the neck. This inflation is not, in my opinion, is not transitory. This inflation is basic and it will continue. And for the Fed to pump $120 billion a month more, they're doing it every month. On top of that, now you're talking about flooding the market with more paper.
And of course, this snake doesn't care about you and I. He doesn't care about the increase of milk cost and cheese and eggs. to us, the end customers. He could give a rat's ass about us. These Wall Streeters care about themselves only. And now that inflation is touching our wages, they're complaining. When inflation was pushing assets prices higher, equities and real estate, making them richer, they had no problem at all. But now that inflation is reaching wages, God forbid your wages go higher. We're going to end the show. But he makes an excellent point, by the way, that wage inflation will be permanent. And while it's good on paper for the average American worker, inflation has ripple effects across the economy. As I said, for every dollar extra you get, you're going to pay $2 more in extra living expenses. And ladies and gentlemen, that leads me to this point. The Federal Reserve, the central bank of the world, is the root of all evil. This is the crime of the century. When the Fed uses this excuse that, we're going to have to do this cocaine operation of increasing inflation and propping up Wall Street, the stock market, the real estate market, commodities, because we're waiting to reach further substantial progress, whatever the that means, what they're doing is actually destabilizing the entire planet. When food prices go higher, when energy prices go higher, this will lead to political unrest across the globe. The last time this happened, it led to the Arab Spring. And now look at what's going on in Tunisia, for example, in Lebanon, in South America, in Africa, and eventually, if the policy of central banks around the world doesn't change and they continue in doing this misguided policy, they will lead to mass destabilization of this planet. We will see a major war, a major conflict within this century, and the root of that conflict will be the policies of central banks around the world. Folks, read your history. In the last century, we had World War I, World War II, and historians attribute many different aspects as the cause for that conflict. But when you dig deep, you realize that the banks at the time, were the reason behind the grievances that led to the conflict and gave fertile ground for nationalism and crazy actors to rise and destabilize the world. And this will happen yet again. The increase in commodity prices, the increase in food prices in particular, the scarcity of food will lead to grievances once again, and this will create fertile ground for major destabilization in the world this century. And therefore, the policies out of the central banks of the world, specifically the Federal Reserve of the United States of America, the central bank of the world, is the crime of the century. Only smart people will understand what I just said. Anyhow, folks, we have to move on here because we cover the market's information in this program, and therefore we have to look at the stock market and how it did today. And here we go. The Dow Industrial Average closing in the red, down 127.59 points, or a decline of 0.36%. The Nasdaq closing in the green by 102.01 points, or a gain of 0.70%. The S&P 500 closing in the red, down by 0.82 points, or a decline of 0.02%. What about the sector's performance today? Leading the pack at number 1 and capturing the gold medal, materials. At number 2 for the silver, energy. And at number 3 for the bronze, communication services, aka Google and Facebook. Of course, materials and energy staged a late-day comeback as the Fed chairman was speaking, because when you think about it, Jerome Powell just said, I'm going to watch inflation grow higher and higher and higher, bigger and bigger and bigger. I'm not going to do anything about it. Oh, and by the way, by not doing anything about it, at least right now, the value of the US dollar goes down, therefore rising the commodities index, commodities across the board, grains, meats, metals, energy, they're all going to go higher, and therefore you saw the late stage comeback for materials and energy. Meanwhile, the laggards of the day led by defensives, utilities, and real estate. What about the advance to decline ratio? The NYSE 71% advancing versus 27% declining. The Nasdaq 79% advancing versus 19% declining. What about futures? Here it is. We saw crude oil also staging a late day comeback. The WTI closing in the green by about 1%. Brent, of course, trades a little earlier, closed slightly in the green, but the assumption is if energy prices continue to rise higher, we will see both the WTI and Brent rising higher tomorrow. What about softs? The Fed Chairman Powell keeps bringing up lumber as an example for so-called transitory inflation. It went up, it went down, and this is exactly what will happen with housing and used cars, yada, yada, yada. Well, here it is, lumber bouncing higher by about 4.5% today. Likewise, we saw sugar and cocoa futures also rising higher, closing significantly in the green by gains of over 1%. Cotton and coffee futures closing at the flat line. Of course, coffee futures cooling down after a massive rise higher. Meanwhile, OJ futures also taking a break after an impressive run higher in the last few days, closing in the red by about 1.5%. What about metals? The US dollar is trading down, at least for today. We'll see how the forex market reacts as it digests the conference from Jerome Powell and the FOMC minutes. But the dollar going down, this will be good for metals. And we saw gold, silver, platinum, palladium all closing in the green. The outlier was Dr. Copper, closing in the red by about 1.5%. And the question is copper not buying the move in the US dollar today? Or is copper just lagging and we will see it rising higher again as we start trading tomorrow? What about meats? Live and feeder cattle futures on the flat line. Meanwhile, lean hogs futures retreating significantly by about 3% or so. What about grains? Upside day for the most part. Sizable gains for rough rice, wheat, and soybean oil futures. Meanwhile, oats, corn, soybeans closing at the flat line. On the other hand, we saw losses, modest ones, for soybean meal and canola futures. Moving on to the big casino, the options market. What's going on here? Leading the pack, the hottest table in the casino today, Tesla, aka the Souffle, closing at number 1 with about 1.5 million contracts traded today for the name. About 53% of those were calls. At number 2, Apple, with about 1.4 million contracts traded today. About 68% of those were calls. And at number 3, AMD, riding higher on the heels of earnings. And of course, we're seeing upside bids here, short covering, etc. And AMD closing with about 880,000 contracts traded for the name today. About 75% of those were calls. Likewise, we're seeing elevated call options buying for Tilray, Alibaba rebounding higher as expected as we see short covering and profit taking. Of course, the sustainability of the bounce in these Chinese names will be dependent on the sentiment. Is the worst of the crackdown behind us, or is this just a mere short covering rally, a bounce, and then we will resume the selling as we get more news out of the CCP? What about the unusual trades that took place in the options market today? Starting with the ticker FB for Facebook. The name is trading down after hours, right after reporting earnings. Of course, the reason is it is technical in nature. We've explained this already. The earnings were already front-loaded after Snapchat's earnings. Facebook rallied significantly, and therefore, regardless of how good the earnings report is, the name will trade down. It is called buy the rumor, sell the news. And here we have somebody who bought the $400 calls, expiration date August 6, with expectations that Facebook will rise higher by over 7% by then. Now, the likelihood is that the buyer of this trade will lose money, but the seller of this trade will capture the premium entirely. And therefore, I'm covering this trade because if you own Facebook in your portfolio, you should have done this exactly. You should have sold the 400 calls, capturing the premium. It's called a cover call strategy, and in this case, the premium was around $2.50 a piece. All in all, the seller of this trade captured about $2 million in premium. What about the trade for the ticker VOO? This is the Vanguard index for the market, the 500 index. We have somebody buying protection here by buying the 380 puts, expiration date August 20th. With the expectations that the VOO will drop by over 6% by then. They paid about $1.30 a piece to enter this trade. All in all, spending about $1 million for this trade. What about the ticker UPS for, you guessed it, UPS? The name was down severely yesterday by the tune of over 7% on the heels of earnings. The earnings were pretty good, but the problem is the volume of shipping was down, indicating that perhaps the best is behind us for UPS and FedEx as people go out and about and they're not relying on packages anymore. But here we have somebody betting for a rebound on the name by buying the 202.5 calls, expiration date August 6, with expectations that UPS will rebound by over 5.5% by then. They paid about 55 cents apiece to enter this trade. All in all, bringing the total to about $385,000. What about the trade for the ticker PDD, Penduru? And ladies and gentlemen, I have a confession. I did buy calls on this particular name yesterday. I talked about the rebound in Alibaba, but by studying the Greeks between Alibaba and Penduru, I was expecting a rebound in the Chinese names either way because of short covering as we get to the end of the week. But when you study the Greeks between Alibaba, Tal, Penduru, the best was the ticker PDD. And today we saw a massive rebound higher. Those options scored over 500% gains today alone. And here we have somebody betting for more gains to come as we see the short covering happening. They bought the 103 calls, expiration date August 20th, with the expectations that the name will rise by over 12% by then. They paid about $2.50 apiece to enter this trade. All in all, spending about $1.75 million. What about the trade for the ticker NEM, Newmont Gold? They're buying puts here, even though the US dollar went down and gold traded slightly higher. Perhaps this was a bet placed before the conference of Fed Chairman Jerome Powell, or they're calling a bluff on the move of the US dollar. Anyhow, they bought the 55 puts, expiration date October 15th, with expectations that NEM will drop by over 11% by then. And they paid about $1 a piece to enter this trade. All in all, bringing the total to about $650,000. What about the trade for the ticker mRNA, Moderna? I still have puts in the name, and even though the stock moved significantly higher, meaning that I have a nice pie on my face right now, believe it or not, those puts did not lose a lot of value. They continue to hold on premium because I bought the September puts. And the reason is the increase of implied volatility within options. There are people betting massively, both for the upside and the downside, that this stock will pop higher or drop like a rock. And of course, all eyes on the booster shot. The bulls who are buying calls are betting that we will hear from the CDC saying perhaps we need a third booster shot to deal with Delta, and this will be good for Moderna. The bears say that we're not going to need a booster shot. Oh, and by the way, the stock is technically elevated, way overextended, and therefore, if we get any hint that a third dose is not needed, then goodbye Moderna. It drops like a rock. And somebody's making a short-term bet here by buying the 330 puts, expiration date this upcoming Friday, July 30th, with expectations that the name will drop by over 5.5% by then. They paid about $1.50 a piece, also known as $1.50 a piece, to enter this trade, all in all, bringing the total to about $1 million. Continuing with interesting trades, and I'm making the list a little bigger here because I know you guys are degenerate gamblers and you like the options market and you skip everything else and you just watch this segment. You wanted tickers? I'm giving you tickers. What about the ticker HEAR? This is for a company called Turtle whatever. They make headsets for gaming. And pay attention here because a lot of you ask me every day. I get this question on a daily basis. How do you interpret this trades? When you see the tickers, how do you interpret the trades? Well, there's no way to find out. You're just going to see the trades. The interpretation depends on your analysis. For example, in this case, and this is the same trader because we have the same volume and the trade was constructed at the same exact time. They bought the 34 calls with the expiration date of October 15, and they also bought the 26 puts, the same expiration date of October 15th, which in my analysis and my interpretation makes this trade a so-called strangle trade, meaning the trader is expecting a massive move one way or the other. They're not sure, so they're buying calls and puts both out of the money, expecting a massive move higher. They paid about $2 a piece for the calls, the 34 calls, and then they paid about $1.50 a piece for the 26 puts. All in all, bringing the total to about $1.7 million. Here's another trade for the ticker STZ, and I have a different interpretation for this one. You can interpret it as another strangle trade, but when doing the technical analysis and looking at the chart, I come to the conclusion that this is an owner of the stock, STZ. This is not a volatile stock, by the way, and therefore I have a lot of support in my analysis and interpretation of this trade. In my opinion, they sold the 245 calls. Remember, they own the stock, so this is a covered call. They sold the 245 calls with the expiration date of October 15th, and they collected about $2.60 a piece in premium. All in all, pocketing about $1 million. Now, they used some of those proceeds to buy insurance. In this case, they bought the 200 puts with the same expiration date, October 15th, and they paid about $2.20 a piece. All in all, $880,000. So they are keeping about $120,000 in premium in pocket from conducting this trade. And when you look at the chart, you'll realize that 245 coincides with the all-time highs in STZ, meaning that there is a rational expectation of resistance at that level, the prior highs, and therefore you sell covered calls. You collect the premium. If the stock goes all the way to that level, you sell your shares, you make a nice profit, and who cares? The stock is going to go down anyways as it faces resistance. In the meantime, you use some of that premium to buy insurance in case the stock goes down for whatever reason. STZ, by the way, is Consolidation Brands, beer and liquor. You know, your favorite. You're drinking it right now. Anyhow, moving on to the heat map analysis. And let's see what's going on here. Right away, we're seeing some earnings reactions. Google trading higher, AMD trading higher significantly. Meanwhile, Apple trading in the downside slightly, not a big deal, losing about 1% or so. The name rallied over 20% in the last few weeks. So those earnings expectations were already front-loaded by the rumor. Sell the news. We don't have any particular theme here, but the short covering in Chinese names is evident. Alibaba closing in the green by over 5%. Pinduoduo, JD, Tal Education, Neo, all riding higher as we see a lot of short covering. We have some other negative earnings reactions, for example, from Spotify, trading down by over 5% today. Likewise, Starbucks, McDonald's, all trading in the red. And the reason is, once again, earnings expectations were already front-loaded by the rumor, sell the news. They've been buying significant amount of call options ahead of time. They made a nice profit, and they dump before earnings, and right away you see the stocks going down, even though in many cases these stocks have delivered nice earnings reports. Beside that, I don't see any theme here. It is scattered all over the place. We're going to see the real reaction regarding the Fed's announcement, or lack thereof, the conference from Jerome Powell starting tomorrow. The market will digest and make a consensus decision starting tomorrow. We have the most important earnings behind us. We have yet to receive Amazon, but after that, the most important earnings are already behind us. Moving on to the charts, starting with the 30 minutes chart of the SPY, the S&P 500. All of what happened today is reclaiming 438 for support. The gap was never closed, and the chart did not recover the all-time highs. But when we zoom in for a 15 minutes chart, we see a cup and handle formation, which played out to the upside, but it failed to go all the way to close the gap. Can we assume that this is a failure and therefore it is a bearish trend or bearish signal, Or should we do the rational thing and not placing any significance on the last 30 to 15 minutes candle because you see profit taking at the end of the day? This is just normal behavior, but the pattern remains intact. We have a cup and handle formation. You can look at it as a cup and handle. You can look at it as a bull flag consolidation. You can look at it as a higher high, a saucer bottoming formation. It doesn't matter. It is a bullish pattern. The challenge now is closing the gap and trading at all-time highs. A reversal before that will be extremely bearish because the setup is bullish. The candlestick behavior is bullish. We just need some buying in the next few days to push this chart higher, perhaps to all-time highs. The only thing that will stop the market right now from going to all-time highs is a change in sentiment. Think about it for a second. Corporate earnings came out pristine. You guys saw the big cap technology stocks earnings yesterday, whether it is Google, AMD, AMD is not a big cap stock, but Microsoft, Apple, all with double-digit gains year over year. The valuation's out of whack, but these earnings give us the excuse to continue to buy these stocks because, hey, what else am I going to do? Yes, the valuation's out of whack, but these companies are growing significantly. Oh, and by the way, the Federal Reserve, Jerome Powell, Papa Jerome, said today that he's not going to taper. And by the way, where is inflation? I don't see any inflation. It's going to be transitory. And even if there is inflation, we don't care about that. We're just going to assume that it's going to be transitory. The Fed is waiting and waiting and waiting for the unemployment rate to go down below 2.5%, which will never happen, by the way, at least in the foreseeable future. Therefore, no tapering. Therefore, once again, a green light for inflation to rise higher and a green light for more speculation and for the party to go on. What will change the sentiment and reverse these bullish trends? It could be Delta. It could be a surprise from China. Who knows? But for now, the setup is bullish. This is a daily chart for the continuous contract of the SPY. If you want to pick, we still have a negative divergence in the RSI, and the MACD indicator is still elevated. It still hasn't done any significant bullish crossing, and we are still struggling to trade above the resistance, now support, at least for now, of 4,384.5. So if you want to look for weakness, you can find that. But when you think about all of what we heard throughout the week from corporate earnings and the monetary policy, you cannot help but to think that we're going to see more of the same. What about the Qs? 30 minutes chart. Likewise, we're seeing a cup and handle formation, which is bullish. It should take the chart all the way to all-time highs. That will be the resistance. The only thing that will pull this chart down is a change in sentiment. For now, any rational trader looking at this chart is not going to say, oh, this is bearish. Any rational trader looking at this chart will see a bullish formation. But once again, technicals is just one block of what moves stocks up and down. This is a daily chart for the continuous contract of the Nasdaq. And here is the slight contrast. When you zoom out to the daily chart, you start to see some bearishness. We still have a negative divergence in the RSI. The MACD indicator is highly elevated. There is a lot of room to the downside. There is not a lot of room to the upside. And therefore, the loss of momentum could happen any moment if we get any change in sentiment here. In addition, the chart is struggling to keep the support of 15,000. So from an intraday perspective, the chart, the setup is bullish. But from the big picture, it remains bullish, but we are starting to see some holes and signs for weakness here. That could all reverse if the short-term charts play out and we see the cup and handle playing out, the Nasdaq trading at all-time highs, then that's a different story. But do me a favor, look at the chart and look at the MACD indicator. Go back to the end of May, perhaps the first few weeks of June. Look at where the MACD indicator was trading and where the chart was trading. Would you like to buy the chart then? Would you feel more comfortable buying the chart then? Or would you feel more comfortable buying the chart right now? The answer is obviously, I would feel more comfortable buying the chart as it is turning the corner. From the momentum indicator's perspective, from bearish to bullish. But I will feel less comfortable when the bullish momentum is already trading at elevated levels. What about the IWM 30 minutes chart? The outperformer today, and when the IWM outperforms, it is a sign for optimism regarding the economy, regarding growth. For example, when yields started to trade down, we saw the IWM also trading down. So the main question here is the reaction from the IWM today is a knee-jerk reaction? Is the dollar's reaction a knee-jerk reaction? And we will see the real reaction tomorrow as we start to digest the press conference from Jerome Powell. We will see. But looking at the technicals alone, they're indicating that the IWM is turning the corner and it's about to trade higher. It has a solid support at 218, and now it is facing resistance around 222, 223. But once that is broken, we will see another rally in the IWM. And here is a daily chart for the RUT, the Russell 2000. And as you can see, the momentum is changing from bearish to bullish. We have somewhat of a bull flag formation, and if the chart breaks above 2,264, then the bulls will get the advantage in the IWM, the Russell 2000, and we will see a rally, say, in the reopening names, perhaps some of the meme stocks. They're all going to trade the same way. But if the Russell 2000 trades higher, it is a sentiment that the market is changing back to the inflationary perspective, that the Fed will let inflation rise higher, and this, at least in the short term, is good for the stock market, specifically these reopening and cyclical names. What about the dollar? Here it is. facing the resistance of 93 and pulling back, not breaking the support of 92. We were waiting and waiting and waiting and waiting for the US dollar to top. And now we got the confirmation from the Fed that they're not going to taper. And by the way, the taper is not even in the outlook because the Fed is waiting for employment to improve. They could care less about inflation. This is what I got from the press conference today. He's assuming that inflation will be transitory. And he's waiting and waiting and waiting for the unemployment rate to go down to 2.5% before tapering. What does that mean? It means that the Fed is waiting to be forced to taper. In the meantime, let's get the party started and let's continue to print a minimum of $120 billion a month to buy bonds and mortgage-backed securities. This means an increase in money supply, which means bad news for the US dollar. We will see if it's a knee-jerk reaction or not. We'll get a confirmation tomorrow. In the meantime, the action in the US dollar was good for gold, and you're seeing gold trading slightly higher. But gold is the mature guy in the room. It likes to wait and wait and wait for certainty before it makes a move. And for now, gold is eyeing the action in the US dollar and saying, what if this a knee-jerk reaction? I'm going to wait for a confirmation. If the dollar goes down tomorrow, then perhaps this will give me, gold, the green light to blast higher. And we are eyeing the next Fibonacci retracement level, which happens to be the resistance at around 1830, 1840, in or around that level. What about yields? As you heard today, even Jerome Powell, the chairman of the Federal Reserve, is dazed and confused of the action in the bonds market, specifically what happened to yields. And therefore, ladies and gentlemen, the action in bond yields, in this case the 10-year yield, is no longer a reliable or solid indicator regarding inflation because it is being artificially distorted by foreign buying from the Asian market and by Fed buying to the tune of about $80 billion a month. In addition, we have a lot of technicals, as he said, and the technicals also go all the way down to the options market. There is a lot of speculation that this so-called economic recovery is bullshit. And this is a zombified economy hooked up on cocaine. And once the cocaine is gone, we will see a reversion back to deflation and recessionary mode. The resistance remains 1.28 basis points. If the 10-year yield is able to break above that level and close above it, sizably so, by the end of the week, then we have a shot at going back to the descending line, which happens to be resistance, and we'll take it from there. But for now, we're looking at the TLT, the weekly chart for the TLT, bond prices. Still plenty of room to go here from a momentum perspective. Likewise, the chart is keeping the support of 149. TLT longs are eyeing a weekly closing above 149. This will enable them to ride higher, perhaps another short squeeze, which will push the TLT above 150. We will see. But again, you got to keep in mind the knee-jerk reaction right after the FOMC minutes and the press conference from Powell today. What about the VIX 4 hours chart? We saw a baby pop, and now it is curling back down if you look at the MACD indicator. So is that all there is for the VIX going all the way back to 20, facing the resistance, failing to break above 20, and now curling back? If this is the case, then this will be welcomed news for the SPY, the S&P 500, and we will see the cup and handle formation playing out higher, with SPY reaches all-time highs. But if this was the first attempt by the VIX to break above 20, it was a failure, but now it is gathering the energy to give it another shot, then the SPY will also suffer some pain here. Of course, a closure above 20 for the VIX will be significant. For now, the only indicator I have on the chart is the MACD indicator, and so far we don't have a negative crossing creating red impressions in the histogram indicating that this pop is over. So for now, there is still the possibility that this was the first attempt by the VIX to break above 20, and we will see another attempt to do so by the end of the week. Until and unless we see red impressions in the histogram, the pop is not over. What about Apple 30 minutes chart? We talked about the importance of 145 as support. The chart gapping down in the morning, but managed to close the gap and trade above 145, closing slightly below the number. We're not going to make a big deal out of it. If anything, the chart is showing resiliency to keep 145 as support. And the assumption is it will be able to trade higher above 145 once again until and unless we see a definitive closing below 145, a clear rejection, the chart will remain trading within range. 145 as support, 150 as resistance. Speaking of range, what about Tesla, the souffle, still trading within range, going all the way to the beginning of the month. The support remains 629, the bear to bull advantage is 657, the resistance at 679, and therefore the bears on paper still have the advantage in this chart until and unless the bulls push the chart above 657 by the end of the week. Can you have high conviction buying puts and betting against this name to trade down? Not right now. And the reason is 629 has been proven to be strong support. Not once, not twice, but this is the third rebound at a 629. If you are a Tesla bear, you want to see 629 being broken first. Then you place the put option trade or the short trade. The assumption is you're shorting Tesla via put options because shorting the stock traditionally will cost a lot of money. On the other hand, the bulls, you want to see a weekly closing above 657 before you start placing upside bets. What about tulips? BTC, what's going on here? A massive rebound higher, lots of short covering. And now what? If you are within the laser beam community, you don't want to see the chart stopping right now. You want it to go all the way to 42,000, which is the resistance, and perhaps stopping right there, grinding its way back and forth, back and forth, back and forth, gathering energy before breaking above 42,000 once and for all. What you don't want to see is the chart stopping right now and reversing to the downside again as the short covering rally comes to a halt. You see, the shorts are paving the setup for the laser beams to push BTC higher. The shorts are responsible for the pop higher this week in BTC and cryptos in general. Well, the bulls, the laser beams, will they pick up the flag from the shorties and build on the rally by buying BTC, or are they already all in and they don't have any disposable income to continue to buy the tulip? If that is the case, then we will see a reversal as the short covering rally comes to an end. What about apes? AMC, what's going on here? We're looking at a daily chart. The majority of the negative momentum is coming to an end here, as you can see from the MACD indicator, meaning that the setup is fertile for the apes to push AMC higher. The question is, similar story with tulips. Do you have the money to continue to buy calls and to continue to buy the stock? Do you at least have the recruiting power to recruit more apes to buy the stock for you? A pyramid scheme strategy? And if you don't, then even though that this is a bullish setup because the bearish momentum is coming to an end, AMC will not go higher. If anything, it will break the support of 32. So it all depends on how strong the movement is. This is a real test for the apes to put up or shut up. Moving on to the conclusion of this video. What do we have on the economic calendar tomorrow? Per usual, we have the weekly jobless claims. And again, Jerome Powell made it clear today that he is eyeing the jobs market employment numbers, not inflation numbers. Meaning, for Powell and the Fed, CPI, PPI, core PCE, Chicago PMI, Philly PMI, Empire State Manufacturing Index, that doesn't matter. Housing prices going through the roof, that doesn't matter to Jerome Powell. He's eyeing and he is watching the jobs market, meaning good news is bad news for the market, and bad news is good news for the market. If the number comes out below expectations, that is good news for the economy. We're seeing less unemployment claims, but this will be bad news for the market as the prospects of tapering becomes closer. But if we get a large number, more people applying for jobless claims and benefits than expected, due to Delta or whatever, this will be good news for the market to rise higher. Lastly, what about the earnings calendar? We have MasterCard and the big one, Amazon, in addition to Twilio. Of course, all eyes on Amazon. This is the important one. It's not just a big cap technology name, but it is also a gauge of how the economy is doing regarding the reopening and the shift from the stay-at-home environment. Anyhow, folks, that's all I got for you for now, and I will talk to you again tomorrow. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.